welcome all. Let's start by introducing yourself. Daniel, yeah.
Hello, everyone. Daniel Elsawey. I'm from Bitpanda. We specialize in institutional client access to digital assets, tier 1, tier 2 banks, brokerages. We have a good feel in the market for what the kind of data is trending right now, from stablecoin issuance, DeFi, yield access in the market. We have over 25 million institutional clients on the platform, and I've had over a decade in digital assets. Lovely to meet you all. Glad to be here.
Stanislav.
Hello, my name is Stanislav. I am head of marketing in XValley. XValley is self-custodial crypto wallet, and also I am marketing advisor in Binarix. Binarix is RVA, a real estate investment platform. And our products mostly for retail, for B2C, and that's all.
Great.
Good afternoon, and thank you very much to all the most resilient people who finally managed to stay to listen to us. I'm Andrey Kostyuk, a general partner and CEO of Alchemy Ventures, a business angel network.
Okay, Andrey, let's start from you. You have a lot of, you used to be a fintech entrepreneur. Now you are an investor and other stuff. Tell us how the regulatory environment evolved around startups, institutions, and investors. Yeah, and what impact it's having right now.
Actually, it evolved quite in a significant manner, and I would describe it in a way that if you want to be a big boy, want to be big boys, you have to play by big boys' rules. This October, I was in Barcelona for blockchain convention, and somebody joked, and it really kind of resonated with me. Like, first time, she said, I am at this conference which feels more like a reg tech or legal tech or whatever it is conference, not a crypto conference. Everybody speak about compliance, KYC, AML, connection to fiat, going back from fiat to crypto. And I think it's a sign of market getting mature, because without complying with the general rules, there is no way to significantly grow.
Stanislav, you want to pitch in on this, on your...
In general, I can agree, because right now we have self-custodial wallet, and we have card and IBAN, and it's a big problem because crypto people don't want to do KYC. They don't like this. From other side, European compliance, European regulator ask about this, and we see right now that crypto should be freedom in general, but right now, especially from Europe, it's more and more regulations. And of course, you can put money from somewhere, from exchange or from another wallet to our wallet, but you can't use card without KYC. And it's like, it's what crypto people don't want to do. And it looks like crypto wallets pretty soon should become like normal fintech. But in this case, it does not make sense, because from other side, normal banks or modern banks like N26 or Revolut, they started to integrate crypto assets, and crypto wallets can do competition with them because they have less resources. But European regulator looks like he wants to put this under one umbrella with one rules, and it will modernize this market, I think.
Great. Let's welcome our new guest. Tell us your name
everyone.
And where are you from?
I'm representing Kraken. My name is Stefanos Angeli. I act as the CEO of the Cyprus entity. Unfortunately, my colleague Alexia had a last-minute emergency, so I'm filling
of course.
in.
Great, Kraken. We had started a discussion about regulation, how it's evolving in your institution, how do you see regulation in your institution?
Well, we welcome regulation at Kraken. We are very active in the regulatory framework around the world. In Cyprus, more specifically, we're focused on derivatives. We offer perpetual futures, one of the first to offer it in the way that we do. Most recently, we launched X-Stocks, which is a tokenization of equities, backed one-to-one, backed with real equities. We try to offer new products to people that want to be involved in the blockchain to feel the, say, transparency of blockchain.
Great. Daniel, I want to ask you also about, do you think the regulation currently in the crypto space, in the DeFi space, started to resemble traditional finance?
That's quite a good question. When MiCA was introduced in January, it harmonized across all of the EEA, the regulation. We had different countries at different stages in the process. Some were very advanced. N26, as mentioned earlier, is our client using our license. But we saw a lot of countries in Western Europe and Central Eastern Europe, for example, that did not have mature specific crypto regulation. So MiCA license allows you to passport all across the EEA. So it really allows larger mass adoption of crypto in the EEA. It's not so fleshed out for derivative products yet, but from a spot custody basis, this is already getting quite mature, and we've seen a lot of institutional clients come to us specifically for that reason. Whether they have a license, they can use ours, or they apply for one with our help and get approved. We see this as a major trend, but in terms of if you think about, is it getting similar to the traditional institutional space? Slowly, yes, but in the last 10 years, it's been very slow, especially with a fragmented market. So we see in the next 5-10 years now, with the introduction of DeFi into the institutional clients, because we see it slightly from a different angle rather than a non-custodial wallet, for example. We see it that clients want institutional access to DeFi as opposed to DeFi with access to kind of institutional products. So we're going to see the advent of AMMs, etc., with access to banking clients. We're going to see the invention of digital swap curves across stablecoin products, which is going to resemble traditional finance. So we see it moving very quickly in the next 5 to 10 years, but the biggest step this year was MiCA licensing specifically in Europe.
Yes, great. We hear that also in the first presentation of Andreas with MiCA and all the regulation coming. I think currently, at least my personal opinion is that regulation is killing innovation in Europe, and we will see if that's right in the future. But let's go a bit around the wallets, future. At least in my opinion, I see a lot of people doing the same stuff. They copy each other. When you create a wallet, do you think, maybe Stanislav, do you have an opinion on that? And then we can get other.
Okay. From what we see right now, quantity of wallets continue to increase. Some companies or even private startups open new wallets. And of course, most of them, if you talk about when big company open wallet, like some brokerage open wallets, they do this very simple, mostly copy someone else. But when someone small startup open wallets, they try to do more targeted for some specific audiences or with some specific goals. Like, for example, simple, yes, stable, they do positioning like stable coins wallet. Our wallet Zeal, we do positioning like for daily usage because we have some earn product where real-time income, and you can, after the space, this on daily basis. It means that your money, you avoid some quantity of your money from inflation. And I think for some, maybe 1-2 years, it's fine. You can do some specific positioning, but if regulation will come and do strict rules, I'm not sure that it will work because revenue from all these activities still not very high for compensate investment And I think in future we will see like a lot of wallets or some percentage of wallets will die, or no, I think will die. Yes, from what we from that quantity which we see right now.
Yeah, for sure. Because if the companies don't differentiate, at least a bit different, we'll see a lot of wallets. And anybody else has something to add on this? Andrey, maybe from your perspective, as you deal a lot with innovation.
I think my perspective would be just macroeconomical. It's nothing different from any other economic sector. It will follow the consolidation rule. So there will be a few major players. Some players will be addressing niche segment. And you can see the same trend in EMIs, for example, because first of them are very successful. And then there have been literally like thousands of those licenses issued. And where are all those companies? There is just not enough market to accommodate everyone. So I agree with Stanislav. I think a lot of them will have to close if they don't find themselves a market niche.
Great. Daniel, what do you think is driving banks to issue their own stable coins?
Banks have realized very quickly that the yield and revenue in digital assets is a lot higher than traditional institutional products. So the big question they have initially was, how do we create a stable coin? Now we've happily transitioned from that because they understand how to do it. What they want to really understand is, can they integrate it into their core business and make it look like an FX desk with a fixed income yielding product, which they can very easily do. The biggest question they have is CBDCs versus bank-issued stablecoins. And what we've seen from tier one banks is that they know that they have enough capital tier ratios to build a stablecoin, which is legitimate in the market, which is very important. This was initially the biggest barrier to entry for stablecoin issuers like Tether, Circle, to gain market traction and market momentum. But as the banks decide to enter in, you see the SG Forge stablecoin, Euro CV, you'll start to see a lot more issued USD, AED, pound, euro stablecoins in the next 5 years. Once you start to see that, you will see the banks start to control the distribution layer of digitized currency, and then they will start to perform all of the functions that you're used to. And for the average client, they just want to understand, how much can I save? What's the interest rate? They don't care whether we stake it on the network as validators, whether we put it on DeFi pools and earn yield for them. As long as it's effectively risk-free, they understand that they get yield. It's another way to earn yield. And effectively, at some point then, they will be able to lend. Even JP Morgan, etc., are now accepting collateral potentially as crypto in order to perform loans. This is the first step. Very high LTVs at the moment, but it's the first step. We saw a lot of innovation in the market from lending platforms, and obviously lending platforms famously blew up a couple years ago, but that was a risk problem as opposed to a concept problem. But now if you push this into the banks, they'll risk control it much more tightly, and you'll see a lot more innovation in the space in terms of stablecoin issuance, lending, trading, and also facilitating general yield.
Okay, so you see the yield component actually driving innovation.
For sure, because all stablecoins are just one-to-one against fiat. So I have one USDC, I have one US dollar. They're based on the same monetary economics, but the yields I can do on a stablecoin, I have a couple more different methods than I can do with a traditional FX currency. So from that standpoint, if you strip away all the complexity of what chain is it on, etc., it doesn't matter. What it comes down to is, if a client has cash and they have another option to get yield or some sort of access to products, this is another way to get access to products. And it's just going to get plugged in as an asset class in FIC in a bank. It's as simple as this.
Okay, any other, Stefan, you want to add something, or?
Well, on the stable coins, I agree with Daniel. It's a matter of what you offer to the client at the end of the day. All clients want to know that their money is safe and that they can make something out of it. So, yes, there will be consolidation, let's say, of providers. That's how I see it. Probably the governments will try to control it in the same way that they do with fiat. But I'm hopeful that even if they do control it, then it's still going to be more beneficial to the end client. There's more yield opportunities to offer.
Okay.
Yeah, I have an unpopular view on that, I think, in this crowd. I don't see how that fragment of crypto world can survive really establishment of digital dollar, digital euro, and other digital currencies, because to surrender emission monopoly for a government is something very, kind of a very strange idea. So I guess it's more a sandbox environment, and governments look at that quite attentively, and we definitely will see digital currencies coming, most probably on private blockchains, and everything's ready for that because Federal Reserve System has Federal Reserve banks with necessary calculating capacity. Same story in Europe. European Central Bank unites 27 central banks country by country. So I see the future as those digital government currencies living on private government blockchains with not too much room for private stable coins to operate.
Can I just ask a question on that?
Yeah, you can, but just to measure something. So if we take that approach, maybe only Bitcoin will survive. Yeah, Daniel, go ahead.
I think you had private blockchains invented since 2015 when you had Credit Suisse doing a settlement coin, etc. And companies such as R3, Hyperledger Fabric, etc. have been trying. The reason why I don't think this will ever work, because a private permission blockchain is basically a database Excel sheet that you already have today. Any of the validation is not done publicly. This is not transparent. You can close the network just like you do in the traditional finance system. So you are just plugging in the word blockchain into the traditional system with none of the benefits of transparency, immutability, etc. So I always will see, whether it's CBDC or stablecoins by banks, if it's not done on a public permission chain with enough distribution in the network, then to me, that's just an innovation center in a bank spending 10 years building something that will never go to market.
It's, I think, just politically not acceptable for governments to have digital currency on public blockchain. Technically, it's obviously a better solution. Politically, I think it's a kind of a suicide. So that's why I see it happening the way I described.
Yeah, it's like the open source war. Everybody is getting open source technologies and then they make them private. But Stanislav, where do you think tokenization is getting traction and what barriers we see today?
Tokenization, it's very old topic, I think, and it's really high level of dependency from local regulators, because Binaries, for example, right now has tokenized some real estate assets in Indonesia, in Montenegro, Turkey, and Turkey, yes, and Dubai, no, not yet. Yes, Dubai want to start, but we're hearing this last maybe 2-3 years. And it's very difficult, because local regulators do nothing for this. But right now, for example, Indonesia put this in sandbox. And previously, for example, we did all this tokenization stuff via using DAO LLC from USA, like a company. But right now, Indonesia created something their own in sandbox model. And I hope in future, another country where real estate investment from retail investors growing, like Turkey, for example, yes, or maybe Dubai, they will move in this area, because in the world we can find some schemas in Ukraine, for example, also, yes, we had previously some tokenization projects like JoJo or JJ, but it's died, yes, but it was via some gray schemas. But from legal side, it started to move, but very slowly. And I think it started to move, government do something just after some big cases, big bad cases when something happened with gray schemas. I think like this situation right now.
Great. Stefane, where do you, from you're a big platform, everybody knows you globally, but where do you see trends coming? If you have something nice to share also from your data, that would be great.
Well, data I don't have on top of my head.
I mean, yeah. I mean, yeah.
Where I see the world moving is towards DeFi, especially. I mean, we at Kraken take it very, very seriously, and we want to promote and make it available to clients for the obvious reasons. Now, in terms of products, we have so many products that we are offering, and we want to continue growing and innovating. Some of them I mentioned before, some others are offered by other group entities, but it really depends on the region. What's our deep liquidity is what we are proud of. And now we couple that with strong regulation around the globe, giving the confidence to our traders. And yeah, we also welcome other companies instead of starting from scratch, joining Kraken, getting all the infrastructure through our embed product, crypto as a service. So even if you're a regulated EMI or even a bank and you want to offer cryptos, we have the infrastructure, we have the knowledge, we have the security for it.
Great. Daniel, you want to add something? I saw you late. Oh, no? Okay. One of the bottlenecks of is the fiat on crypto on ramp, etc. of the institutions. Where are we today in terms of on-ramp maturity and what is still missing? Daniel?
So for on-ramp maturity, it really depends on what type of company it is. You know, if you're an EMI licensed or using a third-party EMI, it's not really an issue. For the banks, if you implement crypto via a white label solution such as ourselves or such as Kraken, for example, then a lot of the time you've already KYC'd your clients, so that they have the fiat in the accounts already. So there's no KYC issue that way. So we see mass adoption moving quite strongly in that direction. The biggest issue we see for fiat on and off ramping is if you're in a regulated environment, a small startup with a license, but your KYC procedures are not bank grades and you have to do a lot of reporting. This becomes difficult for you, difficult for your clients. And in a lot of even mature crypto jurisdictions, it's still quite hard to get certain accounts, especially with traditional financial institutions. So until that relaxes, and we see that probably happening only when all the banks enter into the space, because they will always block innovation, which is not profitable for them. And once they decide to move into the space, of course, they'll open the accounts for all businesses. So that's the biggest bottleneck we see at the moment for clients.
Stanislav, you want something to add? No? So let's, at least my last question, then maybe we can take some questions from the audience. Where do you see the future of DeFi going? And that question is for all of you. Daniel.
Okay. DeFi as a product is very innovative, but is very immature still for institutional access. But the concepts in DeFi where you can earn yields on networks, you can earn yield on liquidity pools, you can earn various different ways of earning income on your assets, which are not using a centralized institution or business, I think is extremely innovative. the one step we're away at the moment from DeFi is having an institution connect to DeFi, feel safe, that they're able to hold wallets on behalf of clients, not in cold storage necessarily, but on-chain, and be able to then access everything within these pools. But there's a quite simple solution for this, because even if you run a liquidity pool on Uniswap, if you build a digital stablecoin issued by yourself as the bank, the only way to enter into the liquidity pool is if you own the stablecoin. You can only own the stablecoin if you're fully KYC'd with the bank. So by extension, your liquidity pool is fully KYC'd, you end up with yield, and you only deal with clients that own your stablecoin in your network. So you effectively get a white-labeled set of clients which you've pre-approved to then access DeFi. And for me, that's when DeFi will start to really take off. It's huge right now from a retail standpoint, but from an institutional standpoint, that's the biggest gap.
Stanislav?
I can say from retail side, because right now we see that DeFi growing, especially from retail intent, maybe because of this over-regulation, because previously I worked in brokerage, and sometimes when you want to put money from bank account to brokerage, we had some issue in some countries in Europe, and that's why younger trader, I can say, yes, they try to use some alternatives from brokerage to DeFi trading. And I think this trend will continue, but we also see some cases when the local regulator wanted to integrate some KYC in DeFi or ask it. But I mean, I'm not sure that will happen because, or maybe it will happen in decades and years, because it will be a parallel system. Right now it's parallel system, but I think some quantity of money from regulated trading will move to DeFi trading because of this over-regulation, especially from Europe, UK, Australia, and etc. I think this trend will continue, and it will be more massive instead of right now.
For me, two main trends that I see here. First, we already touched upon quite extensively is the proliferation of government-backed digital currencies. But even the more important one probably is real-world asset tokenization. I think that it's a beautiful technology to boost liquidity, boost reliability, because yes, blockchain, as we know, is immutable by design. So RWA, I think it's the best use for this technology, and maybe we'll see the biggest successes there during the next 5-10 years.
My fellow panelists covered most of the points I wanted to talk about. Yeah, I have to agree on the tokenization of real assets. That's like one of the main strengths of blockchain. Is still infant. I see it growing very much. On the DeFi part, there are still challenges for it to expand in the way that it could to materialize, let's say, the potential. There are limitations, as Daniel mentioned before. For retails right now, it works. Sometimes it doesn't, but I think in 2-3 years' time we'll be in a much better position to utilize it even further.
Great. Do you have any questions? Maybe we have one question. Yeah, Nasos. You are allowed.
Hello, guys. So 2 questions. One is about the yield and one is about tokenization. Just FYI, like a background, like more than 10 years in this industry, and I'm trying still to figure out 2 things. Where does the yield come from exactly? People say it's from fees and stuff like that, but we've seen liquidity pools offer up to 15, 16, maybe 20% sometimes. So I just have this question. Also about tokenization, you said about real-world assets, and we've only seen this in Dubai because the land registry accepts the tokens as ownership. Yeah, most people, like 99% of the world, still uses tokens through an SPV. Correct me if I'm wrong, by the way, but this is how it works today. Basically, you own shares of an SPV, and you don't really own the real estate, basically. Okay. Also, about tokenization, you can have multiple shareholders or multiple owners today without the tokens. You can pay with Bitcoin. So what's the proposition here for actually tokenizing real-world assets?
I can try to take the yield question.
Go ahead.
Okay. Yield on crypto assets generally, doesn't matter what it is, stablecoin, normally is in 3 areas. 1, you can run a validator on the chain. Validate, you get yield. You're rewarded for being successful on the chain, and that's your implied interest rate for the end of the year, effectively. The other way to do it is in 2017, 18, a lot of firms were taking in your crypto. They'll lend it out at 7%, give you 4%, make 3%, something like this. Typical spread. The third way, which is not that popular and is not really offered by exchanges necessarily or brokers, etc., but is done by hedge funds and market makers, is you can go into the perpetuals market and you just run a delta neutral strategy, which is just go long on the perp, short on the asset. You're earning the funding rate every 6 hours. You're earning a couple bips a day, for example. So you're making, say, 5% a year risk-free. And you give the client 3%, as an example. But this is an active strategy, right? This isn't a just buy and hold strategy. Those are the 3 core yield forms in these assets. No, you are. So when you have a liquidity pool which is quite illiquid, let's say $1,000 of liquidity in total, if you put in $800, the whole way the economics works is when there's a trade, you get a share based on how much you own of the liquidity pool. So for you, owning 80% of the liquidity pool, it's going to look like 200% APY. But because it's such low liquidity, if I come in and I sell $400 worth of that asset, it will go down 40%. So the vol is massively high, and that's, your yield is there to compensate you for the vol. If you take on, let's just say an ERC20 or ETH USDC pair where it's hundreds of million in liquidity and you put $1,000, yeah, you're going to get 3% a year maybe, but the volatility is plus or minus 5% max really per trade. And to be honest, with Uniswap like version 3, where you have tiering of liquidity, it doesn't really move the price that much. The only time the price really adjusts is if there's a big move in centralized exchanges like on a Kraken or a Coinbase or a Bitpanda, and then you have arbitrage happening, it will adjust the price. But you're not going to get huge vol. The big APY numbers you always see on very illiquid tokens, even 1,000% a year. But 1,000% a year when you've lost 90% of value is useless. So this is why it's illiquid, because it's not popular, and it's never recommended to go into that with a lot of money, especially if you're majority of the liquidity pool.
Anyone else to add something on Nasos?
Yeah, I think I can just add to that again, the macroeconomic perspective. Yield is always a function of risk. Instrument is not important. Is it crypto? Is it, I don't know, horses, dogs, money? So if they offer you 20%, it means they couldn't raise money at 19. And then it's up to you to decide if you want to take this game or not. It's not specific to crypto or anything else. That's part of the risk assessment. That's why they pay high yields. Exactly. That's why banks pay you nothing and then pay you 20%, because that's the risk perception of the market. You can't do anything about it effectively. That's how a market prices that.
We have the last question here. Yeah, thanks, Andrea.
Yes, very insightful panel. Thank you very much.
Thank you.
So This is a question for every one of the panel. How do you see the separation between state and corporate institutions on stablecoin, and who will be the outright winner?
Okay, who wants to start? I will tell mine at the end.
I did touch upon it on a previous question.
Yeah, so how do you see the separation between state and corporate institutions on stablecoin, and who will be the outright winner?
Okay, it's gonna be a great battle. This is something I can tell you for sure. It's gonna be a long battle as well. Now, at the moment, corporate wins, let's say, the round. However, given the traditional powers that governments have, I suspect that they will start fighting against the corporations, as they do for certain things, and gain ground eventually. I don't see a clear winner coming out of it in the next 5 years at least. I cannot predict any further than that. But it's for sure a fight that will keep going, and it may start leaning towards the governments winning it after the 5 years.
I would probably just add, I think you're going to have a separation between money and state. So right now we have central banks control the money supply, give it to wholesale market, bank, and then retail. I think you will have subsections of stable coins in banks, which then are a portion of the total central bank money supply. But as you see demand increase, those small pools of hundreds of billions of dollars in those stable coins are then going to become more prevalent, and it's going to be the first time that a bank can technically mint and burn assets. They're not producing more money supply, so M2 stays the same, but the demand for the digital component will be fully managed by banks, because from an innovation standpoint, they can run full swap curves, they can build mortgage products on these items. They do this already in wholesale market. So I see, even if a CBDC does exist, CBDC will be a portion of the money supply, and then you'll have stablecoins by banks for active usage, investment, and trading.
Anything? No?
Yeah, just when I've been listening, I understood that there's nothing new under the sky, because back in the day, each commercial bank used to issue its own promissory notes, and that's finally how fiat money appeared, in the form that we know today. So maybe that's just another cycle, with the stable coins issued by the banks being effectively the promissory notes of the 21st century.
Yeah, exactly. I believe only the government stable coins will survive, maybe in 30, 40, 50 years. And I believe Bitcoin. That's it. Hopefully Sui will survive, because I know the team. I like the team of Sui. But the other cryptocurrencies and digital coins, of course, they will be in the market. You will make money, you will lose money. Yeah. But I think that's it. Thank you for listening and watching us. And thank you guys for the insights. And Melanie?
Very much. There's lunch and drinks to follow. And this brings us to the end of the Cyprus Fintech Summit 2025. Shall I say see you next year? See you next year.